Something very strange is happening in global markets right now. War risks are rising, energy supply routes are under threat, commodity markets are becoming increasingly volatile, and yet stock markets are acting like nothing is wrong. In fact, in many cases, they're doing the exact opposite. They're rising, investors are buying risk assets, and volatility remains surprisingly low. But history shows something important. When markets ignore geopolitical risk for too long, the correction often comes suddenly. And when it does, the shock usually shows up first in one place: commodities, oil, gold, energy, food, the physical resources that power the global economy. Right now, many analysts are warning that this exact scenario could be forming: a geopolitical shock that markets are underestimating, one that could trigger a sudden surge in commodity prices. And if that happens, the consequences could ripple through inflation, stock markets, and global economic growth. So today, we are going to break down a critical question. Are markets dangerously ignoring rising war risk? And if they are, could a commodity shock be the next big market surprise? Welcome back to the John Forecast, where we break down the macro forces shaping gold, oil, commodities, and global financial markets. If you're someone who wants to understand how geopolitics, inflation, and energy markets affect investing, you're in the right place. Because today, S Story connects several major developments happening simultaneously: rising geopolitical tensions in the Middle East, volatility in oil markets, safe haven demand for gold, and a growing concern among analysts that markets may be too complacent about geopolitical risk. The paradox in today's markets. Let's begin with the biggest puzzle. Markets look calm, but the world looks anything but calm. Over the past weeks, the global environment has become significantly more volatile. The conflict involving Iran and regional powers has escalated rapidly, triggering concerns about energy supply disruptions and broader economic instability. Oil prices briefly surged above $119 per barrel, a near 4-year high, before falling again when markets began pricing in potential de-escalation. And analysts at major banks are warning that if the conflict intensifies, the impact could be severe. Some projections suggest the S&P 500 could fall around 10% if geopolitical tensions continue to escalate. Yet, despite all of this, investors have not dramatically reduced risk exposure. In fact, many markets appear to be behaving as if the crisis will resolve itself quickly. This phenomenon is something analysts call geopolitical complacency. Why markets often ignore war risks. At first glance, this might seem irrational. Why would investors ignore rising war risk? But there is actually a logical explanation. Financial markets have a long history of underreacting to geopolitical events at first. Even the CEO of Goldman Sachs recently noted that markets often respond only when geopolitical events begin affecting real economic growth. In other words, markets don't react strongly to headlines. They react to economic consequences. And until those consequences appear, investors often assume the crisis will fade, but this assumption has sometimes proven very dangerous. The commodity shock pattern. If you look back at history, you'll notice a pattern. Many geopolitical crises follow the same economic trajectory. First comes the conflict, then comes the disruption of supply chains, and finally comes the commodity shock. A sudden surge in the prices of critical resources, oil, natural gas, food, metals. These price spikes often become the mechanism through which geopolitical tensions spread into the global economy. Think about this for a moment. What caused some of the biggest inflation shocks in modern history? It wasn't always monetary policy. It wasn't always government spending. In many cases, it was energy supply disruptions triggered by geopolitical conflict. The oil market warning. Oil markets are currently the clearest signal of rising geopolitical risk. Oil doesn't just respond to economic growth, it responds to physical supply threats. And right now, those threats are growing. One of the most important factors is the Strait of Hormuz, one of the world's most critical energy choke points. Nearly 20% of global oil supply passes through this narrow shipping route every day. That's roughly 20 million barrels of oil daily. Any disruption there can send shockwaves through the global energy system. And that's exactly why markets reacted so strongly when tensions escalated. Why oil is the first domino. Oil plays a unique role in the global economy. It fuels transportation, manufacturing, agriculture, shipping, and countless industrial processes. Even in the age of renewable energy, oil still accounts for roughly 1/3 of global energy consumption. This means when oil prices spike, the entire economic system feels the impact. Transportation costs rise, food becomes more expensive, manufacturing costs increase, inflation accelerates, and central banks are forced to respond. The inflation feedback loop. This brings us to one of the biggest macro concerns: inflation. After years of high inflation following the pandemic, central banks have been trying to stabilize prices. Interest rates were raised aggressively, demand slowed, and inflation began gradually cooling. But a new commodity shock could reverse that progress. Energy prices are one of the most powerful drivers of inflation. When oil surges, inflation almost always follows. And that creates a dangerous feedback loop. Higher oil prices push inflation up. Higher inflation forces central banks to keep interest rates higher. Higher interest rates slow economic growth. The gold signal, while oil reflects the physical supply risk, gold reflects something different: financial anxiety. When geopolitical tensions rise, investors often move into safe haven assets, and gold is historically the most important one. Gold tends to perform well during periods of conflict, inflation fears, and economic uncertainty. In fact, studies from the World Gold Council show that gold has historically delivered positive returns during major geopolitical events, including wars and financial crises. That's why many investors watch the relationship between oil and gold prices as a key macro indicator. Oil reflects the supply shock. Gold reflects the fear of financial instability. A geopolitical commodity cycle? Some analysts believe we may be entering a new phase where geopolitics becomes the primary driver of commodity markets. Recent analysis suggests that rising global conflicts could coincide with a broader cycle of surging commodity prices through the late 2020s. If that scenario plays out, the world could experience a prolonged period of energy volatility, commodity inflation, and geopolitical competition over critical resources. The China factor. Another reason commodity markets could become more volatile is the changing geopolitical landscape. The world is gradually moving from a unipolar system dominated by the United States to a more complex multipolar system. China, Russia, the United States, Europe, regional alliances. These powers are increasingly competing for influence over trade routes, energy supplies, and strategic resources. And when great powers compete, commodities often become strategic assets. The food shock risk energy is not the only commodity vulnerable to geopolitical shocks. Food markets can also be affected. The Russia-Ukraine war provided a clear example of this. Both countries are major exporters of wheat and agricultural products. When the war disrupted supply chains, global food prices surged dramatically. Research shows that geopolitical events during that conflict triggered significant increases in energy and agricultural commodity prices. Markets versus reality. So why aren't markets reacting more aggressively right now? Part of the answer lies in investor psychology. Markets tend to believe conflicts will resolve quickly. Investors assume diplomacy will prevail. They assume supply chains will adapt. And most of the time that assumption works. But occasionally, it doesn't. The risk of a sudden repricing. The real danger isn't gradual market adjustment. The real danger is sudden repricing. Markets can ignore geopolitical risks for weeks or months. But when new information arrives that changes the outlook, prices can move extremely fast. We've seen this many times before. The Gulf War, the 1970s oil crisis, the Ukraine invasion. Each time, markets initially underestimated the impact and then suddenly repriced everything. What investors are watching. Right now, investors are watching several key indicators: oil prices, shipping disruptions, commodity inventories, currency movements, and central bank reactions. These indicators provide clues about whether geopolitical tensions are beginning to affect the real economy. Let me ask you something. If a major commodity shock were about to hit the global economy, where would the first warning signs appear? Not in stock markets, but in the commodity markets themselves. The next possible scenario. So, what happens if tensions continue rising? Here is a possible chain reaction. Oil supply disruptions push energy prices higher. Higher energy prices push inflation higher. Central banks delay interest rate cuts. Economic growth slows. Stock markets reprice risk. And investors rush towards safe haven assets like gold. The big picture. The key takeaway is simple. Markets may currently be underestimating geopolitical risk. That doesn't mean a crisis is guaranteed, but it does mean the global system is becoming more fragile. And when fragile systems encounter unexpected shocks, the consequences can be dramatic. The world today is more interconnected than ever. Energy supply chains stretch across continents. Commodity markets connect economies from Asia to Europe to North America. And geopolitical conflicts can ripple through these systems faster than ever before. If rising war risks begin disrupting commodity supply, markets could be forced to reprice risk very quickly. And that's why analysts are paying close attention. Because sometimes the biggest market moves begin with something very simple: a shipping route, an energy pipeline, or a geopolitical conflict that markets initially ignored. If you found this analysis helpful, make sure to subscribe to the channel for more deep dives into gold, oil, commodities, and global macro trends. And now I want to hear from you. Do you think markets are underestimating geopolitical risk? Or do you believe investors are correctly assuming the conflict will stabilize? Let me know in the comments. Thanks for watching, and I'll see you in the next video.